My name is Andrew Stonson. I want to welcome you to the Global Equity Valuation Competition. In our next competitor is going to be Saurav. He's going to be presenting Aptus Housing Finance Limited. I'm looking forward to learning about it. The Global Equity Valuation Competition is sponsored by Valuation Masterclass as well as Koifin, which I want to appreciate them for supporting. So let me bring you in. Saurabh,
Yeah. Hey, Andrew.
yeah, are you ready to go?
Definitely.
All right, I'm bringing your presentation up and I see it now. So I think we're ready. So what I'm going to do is I'm going to exit. As soon as I exit, then you can start. Okay, so I'm going to exit now. You can start now.
Thank you. So, imagine you run a small hardware shop in a tier 3 or 4 town. You've been in business for 11 years. You own the shop. You own the land it sits on. You walk into a bank. You ask for a home loan. They turn you down. That person, that hardware shop owner is the entire business model for Aptus. Aptus is a housing finance company based in Chennai, India, that decided 15 years ago to go where the big banks wouldn't, tier 3 and 4 towns. As you can see at the top center, I initiate buy coverage on Aptus with a target price of INR 268 and an upside of 9%. Today, Aptus has an AUM of INR 123 billion, which has grown at a CAGR of 28%. Aptus is structurally different from most HFCs because they operate on a dual entity structure. An HFC alongside an NBFC subsidiary. This lets them originate higher yield non housing loan products, which a pure HFC player cannot do freely. While Aptus has definitely high profitability characteristics, but in India, affordable housing finance is just not business. It is a financial inclusion story. Aptus is providing loans to borrowers in towns which the big banks might not touch. That motivated me to cover this company. India's mortgage market is still in its early chapters at just 16% mortgage to GDP ratio. That's a long runway ahead. It's a rising tide waiting to shift the boats. Now, let's see what my thesis is based on. It's primarily three pillars. One, Aptus yield on advances is 17.2%, roughly 300 to 400 bips higher above Home First and 100 to 200 bips above India and Shelter. I'm arguing that the yield is sustainable, not cyclical. Aptus has maintained 100% in-house sourcing for 15 years. No DSAs, no third-party agents. That gives them a 80% login to sanction ratio versus an industry average of 45 to 50%. This is how you control the underwriting quality and then you protect your yield. Their average LTV is 37 to 40%, which is the most conservative in the peer group. The collateral cushion is real. There is an actual safety net. Pillar 2 is the ROA, which is 7.9% against a peer range of 3.4 to 5.8. Aptus is just not slightly better, it is in a different category altogether. ROE of 20.2% against a peer range of 14 to 17%, and OPEX to AUM of 2.7, which was held flat every single quarter during a period of aggressive branch expansion. Last pillar is about the near term noise in the market. Two things have spooked the market. The growth guidance was revised downwards in three consecutive quarters, and the MSME book showed a slight uptick in the NPS. On the guidance misses, three downgrades in one row is a red flag for the near term visibility. But the company saw a 21% growth in Q4, the results of which came 4 days back, and Q4 had the highest quarterly disbursements. I am not giving them credit for promises. I'm giving them credit for what they've actually done. On the MSME stress path, GNPA at 1.5% is slightly elevated, but the housing book is clean. The MSME stress is seasonal, not systemic. And critically, you're being paid a higher spread to take this risk. Next, let's look at how the valuations turn out to be. I used the scorecard based method, which I would also like to call the moonshot analysis, I basically score Aptus against the peers across three buckets: business model, profitability, asset quality, and derive at an implied price to book multiple of 2.9x. I corroborated it using the comparable company method. And again, I arrive at a price to book multiple of 2.85x. Those two methods converge. That convergence is conviction. Let me leave you with two key takeaways. First, Aptus earns a 7.9% ROA in a sector where the peers earn 3.5 to 5.8. Aptus is being offered to you at a sector average multiple. Second, the long term thesis is completely intact. There is a credit gap for self employed borrowers in Tier 3 and 4 India. Aptus's unique position, the in house sourcing, the dual entity nature, the 40% LTV, 15 years of compounding. I understand no company is flawless, but an investor should at least be rewarded for the risk they take. And so far, Aptus is being offered to you at a sector average multiple, like I reiterated before. Let's go back to that hardware shop owner in that tier 4 town who got turned away by every single bank. Aptus showed up for him. They've been showing up for 15 years. The market stopped showing up for Aptus. I think that's a mistake. Thank you.
Excellent. Go back to your first page if you can.
Yeah.
Okay. So the first thing is, okay, ROA is pretty strong.
Yeah.
And but it's probably not a big is it a standout relative to other competitors, or is it about in line with the industry?
It's a standout as compared to other competitors.
What roughly is the other competitors on ROA?
Yeah, it's between 3.5 to 5.8. The closest one is India Shelter at 5.8%.
And is that because of the composition of the portfolio, or is that because of something that they're doing different besides that?
So it's a mix of two things actually. One, the segment mix that Aptus operates in is slightly different because, like I mentioned, it's a dual entity structure. So that gives them leverage. Second is the cost control. I mean, the cost is stable across all the 4 quarters. Even if we look at Q4 results that came in a few days back, the OPEX to AUM is still in the same range. So that gives them leverage.
Okay. And then if you look at, I don't know, let's think like 5 to 10 years out. What type of growth rate, what are they going to be able to grow their loan book at, or their balance sheet at over the, on average?
Right. So that's a very good question, actually. And the same question was discussed in the Q4 results. So the long-term growth rate for the next 6 to 7 years, the company plans is around 22%. So 22 to 25 is what they are estimating. And even the 22% rate is something that they're saying is on the conservative side. And they don't want to be they don't want to give aggressive commentary in the press. But that's the broader growth rate.
And have they been through any particular crises since they've incorporated, or have they had a pretty smooth ride?
So, to be very honest, the ride has been pretty smooth. The market is treating one particular incident as a very big crisis, and I would like to elaborate on that if we have the time.
Yeah.
Yeah.
Go
So,
ahead.
yeah, there's a PE investor called Westbridge Capital who's been exiting the company since I think June 24, if I'm not wrong. So the market has been punishing the company primarily because of that, because Westbridge was one of the early investors in the company who supported the company since the beginning. And now when the company made IPO in I think 2021, and post 2020, May 2024 was the time when Westbridge started selling the stake. And September 25, which is close to 7-8 months from now, they've completely offloaded their stake. So the market is treating this as a stress signal, which in my view is more of a liquidity event and not a stress signal. So this was the primary incident that has been affecting the company, and we saw the stock price as well. It's slightly at the bottom of the range, but yeah, that is one key event which I feel might have impacted.
And I was a bank analyst for my first 10 years. And so I like banks, but one of the questions I have is the price to book multiple. As you've shown, it's kind of in line. You've talked about how the share price has been hit, recently, But what is the potential from your perspective of where price to book could go to?
So right now, I think if we are assigning a price to book of 2.9, I believe it has the capacity to reach in the next 3 to 4 years a price to book of 3.5, which would be the sector leader. So 3.5 is the ideal price to book multiple, which I feel Aptus deserves definitely. And I see Aptus in a very long term view, not in a very 1 to 2 year horizon, because there's the global markets are very volatile. There are wars that are happening. There are turbulent times right now. So for all of that to factor in, for all of that to stabilize, I think we would definitely need to give Aptus some time. But 3.5 to 3.4 to 3.5 is the range that I feel is something that Aptus deserves.
Okay, my last yeah,
Thoughts?
my last question is about the banking sector sometimes can be a commoditized. Like when some bank or institution does really well, others just copy it. And what's the risk that over the next 3 to 5 years they can't grow as fast as they thought because competitors are putting up a much stronger fight than you expect?
Right. So two key differentiating factors actually. One is the structure that we talk about. Getting an NBFC license, forget India, any region is not that easy.
Right.
So entering that market and competing on that level, if not impossible, it's the probability is very high, is what I feel. So that is a very big moat that Aptus has. Second is the in the last 15 years, they've trained their loan officers so strong. If I know for a fact, I've read reports and I've interacted with some people in the banking space, the loan officers know the customers on a very grassroots level. So they do a very offline research. They've understood the patterns and the way how the south. So basically, Aptus operates in the south of India. So they've
Mm.
studied the market, they've analyzed the patterns so deeply in that sector, that specific location, that someone else coming in and just taking over or growing at a faster rate than Aptus seems to be a little difficult. I'm not going to rule out the possibility of it, but
Okay.
it has a very strong holding on the ground. And the promoter himself in, I think, more than 21 years he spent in the financial services sector. So
Okay.
the company really has a very good management support. Yeah.
Great. I have a lot of other questions, but we have to wait until after the competition. But well done. How does it feel to complete this portion of the competition?
It's honestly happy and sad, because I'm really happy that I got to speak to you today, and it's genuinely a privilege. I've been following you for quite some time, and I'm sad because we won't get those messages on Slack anymore. The cute little rockets, the tiny messages by Himani, BP, Madhura. So it was an amazing journey, and I think I'm a valuation professional
Mhm.
myself, but this was the first time that I actually spent some time outside of work thinking about the company, how the 3 pages report, oh my God, Andrew, concise, the whole purpose of compiling the whole research into 3 pages was super interesting. And especially the 6 minutes, the 8 minutes, and now the 6 minutes was something that made me refine my thought processes, refine my research a lot more.
Yeah.
So
Well,
really grateful, a huge shout out,
yeah.
definitely. Shout out,
Well,
yeah.
well done. And I'll see you in the Slack channel.
Yeah. Thank you, Andrew. Have a
Yep.
good evening. Bye.
Yep. Okay. Wow. India is incredible with so much growth. And if you're a high quality finance institution or bank, the market is just enormous there. So that was Saurav, who's presenting Aptus Housing Finance Limited in this Global Equity Valuation Competition. Fantastic contestants that are competing today. Remember that the Global Equity Valuation Competition is sponsored by Valuation Masterclass and also Koifin. My name is Andrew Stotz, and I'll see